Let me ask you something. What if I told you that the order in which you take money out of your savings accounts could cost you or save you thousands of dollars every single year? Not because of the stock market, not because of some risky investment, simply because of which account you go to first. Most Canadian seniors have never really thought about this, and honestly, why would they? You worked hard, you saved, you followed the rules. But here's the thing. The rules have changed. And in 2026, if you're drawing from the wrong account at the wrong time, you could be quietly losing a big chunk of your government benefits without even realizing it. Stay with me, because by the end of this video, you're going to have a clear picture of exactly what to do and what to avoid. Welcome. Today, we're talking about two of the most important accounts in a Canadian retiree's financial life: the TFSA, which stands for Tax-Free Savings Account, and the RRIF, which is a Registered Retirement Income Fund. If you're not sure what those are, don't worry. We'll explain everything in plain language. What we're really answering today is this: when you need money in retirement, which account should you pull from first? Because believe it or not, getting that order wrong can affect your old age security, your guaranteed income supplement, your dental coverage, and the amount of tax your family pays when you're no longer here. And I also want to share with you one specific strategy that financial advisors are calling the golden window. It's a period of time, likely right now if you're between 60 and 71, where you can make moves that protect your income for the rest of your life. We'll get to that shortly. Before we get into today's topic, if you are new here, welcome. This channel is updated every single day with the latest news, changes, and tips for Canadian pensioners. We have covered everything in simple language, no jargon, just the information you actually need. Hit subscribe and turn on notifications so you never miss an update that could affect your pension or your pocket. Now let's get into today's video. Let's start from the beginning and keep this really simple. Your TFSA, your tax-free savings account, is like a special jar where your money grows completely sheltered from the government. When you put money in, it's already been taxed. When you take money out, you pay nothing, not a penny. And here's the beautiful part: the government doesn't even count it. When they calculate your income for the year, TFSA withdrawals are completely invisible. They do not affect your old age security. They do not affect your guaranteed income supplement. They don't even count toward your dental plan eligibility. It's as if the money never existed, in the best possible way. Now, your RRIF is very different. Your RRIF is what your RRSP becomes once you reach age 71. At that point, the government says, all right, we've let you shelter that money for decades. Now it's time to start taking it out. And when you do take it out, every single dollar is treated as regular income. It gets added to your annual earnings, just like a paycheck. That means it can push your income higher, and a higher income means you might start losing some of your government benefits. So right away, you can see why the order matters. One account is invisible to the government. The other one gets counted for everything. Now let's talk about what happens when those counts start to matter. Here's where a lot of seniors get a nasty surprise. They reach retirement, they start receiving their Canada Pension Plan payments, their old age security kicks in around 65, and everything feels fine. Then they start making RRIF withdrawals on top of that, and suddenly they get a letter from the Canada Revenue Agency saying they have to pay back some of their OAS. This is called the OAS Clawback, or more officially, the OAS Recovery Tax. In 2026, if your total net income for the year goes above roughly $95,000, the government starts taking back 15 cents of your old age security for every dollar above that limit. For some people, that adds up to hundreds or even thousands of dollars per year, money that just quietly disappears. And for lower income seniors, the situation can be even more serious. There's a benefit called the Guaranteed Income Supplement, or GIS. It's designed to help seniors who need a little extra support, but, and this is very important, for every dollar of RRIF income you receive, your GIS can be reduced by 50 to 75 cents. That's a brutal reduction. In some cases, one unnecessary RRIF withdrawal can wipe out months of GIS payments. So the question isn't just which account do I use, it's how do I use my accounts without accidentally triggering penalties on the benefits I've earned. And that brings us to what I mentioned earlier, the golden window. All right, this is really important, so I want you to pay close attention here. This might be the most valuable part of everything we discussed today. Between the time you retire and the time you turn 71, there is a window, a unique period in your financial life where you may be in what experts call a low tax valley. Your employment income has stopped. You may not have started your full OAS yet. Your mandatory RRIF withdrawals haven't kicked in. And that means your taxable income might be lower than it has been in decades. Think about a retired couple. Let's call them Margaret and Bill. Margaret retired at 63, Bill at 65. They have money in their RRSPs, their TFSAs, and a modest non-registered investment account. Their income right now is relatively low. Their tax brackets are low. This, for them, is the golden window. What smart planning says to do during this window is this. Rather than waiting until you're 71 and are forced to take money out of your RRSP or RRF in large amounts, start drawing it down now, gradually, in a controlled way. Take just enough each year to fill up the lower tax brackets. In 2026, the lowest federal tax bracket covers income up to about $58,500, taxed at only 14%. That's actually quite manageable. By drawing down your registered savings now in smaller amounts at lower tax rates, you shrink the balance that will be subject to mandatory withdrawals later. And whatever money you free up, you can move it into your TFSA where it will grow and compound completely tax-free for the rest of your life. There's also a very specific trick available to Canadians who are 65 or older. If you convert even a small portion of your RRSP to a RRIF at age 65, you can withdraw up to $2,000 per year and claim something called the pension income amount. That credit effectively lets you take that $2,000 out at zero federal tax. It's a small move with a nice payoff. Does this apply to you if you're between 60 and 71 and still have money sitting in a registered account? The answer is very likely yes, at least worth a conversation with your advisor. Now let's talk about what happens once you hit 71 and the mandatory withdrawals begin, because once you're past the golden window, your RRF is going to produce income whether you like it or not. At age 72, the minimum withdrawal from a RRF starts at around 5.4% of whatever the account balance is. By the time you reach 80, that percentage has climbed to nearly 7%. If you have a sizable RRIF, those withdrawals can push your income into territory where your OAS starts to shrink or even disappear. So here's the strategy for this stage of life. Use your mandatory RRIF withdrawal to cover your regular monthly expenses, groceries, utilities, the things you need every month. That's unavoidable and it's predictable. But when you need a bigger lump sum, maybe you want to take a trip to see the grandchildren, replace your car, do some work on your home. That's when you turn to your TFSA, because that TFSA withdrawal won't show up on your tax return. It won't push your income higher. It won't trigger any clawback. You can take out $20,000, $30,000, whatever you need, and your OAS stays perfectly intact. It's like having a secret account that the government simply cannot touch. And remember, any room you create in your TFSA by making a withdrawal comes back to you the following year. So if you take money out now, you can put it back later. That flexibility is genuinely one of the best features of the TFSA. Here's something that many people don't think about until it's too late. When you pass away, your RRF doesn't disappear. It doesn't quietly transfer to your family. What happens is that the Canada Revenue Agency treats the entire remaining balance of your RRF as income on your final tax return, all of it, in 1 year. That can mean a massive tax bill. If you have $400,000 or $500,000 sitting in an RRF when you pass away, your estate could owe more than $200,000 in taxes, money that would otherwise go to your children or grandchildren. Your RRF becomes, in a very real sense, a gift to the government instead of to your family. Now, if you have a surviving spouse, there are ways to roll the RRF over to them without that immediate tax hit. But eventually, that bill comes due for someone. This is exactly why the strategy of spending down your RRIF during your lifetime, using that money for your lifestyle, and letting your TFSA continue to grow is so powerful from an estate planning perspective. When you eventually leave money to your heirs, TFSA assets pass to them completely tax-free. No final return, no tax owing, nothing. It's the cleanest, most efficient way to leave a financial legacy in Canada. So the simple principle here is spend the RRIF during your lifetime. Save the TFSA for your family. Let me paint you a picture. Imagine a woman named Dorothy. She's 67 years old, retired at 64. She has $180,000 in her RRSP, about $90,000 in her TFSA, and she receives a modest CPP payment each month. Her income is fairly low right now. She's squarely in that golden window. For the past few years, Dorothy hasn't touched her RRSP at all. She figured, why take it out now and pay tax when I can just leave it alone? But here's the problem. When Dorothy turns 71, that RRSP becomes a RRIF, and she'll be forced to withdraw thousands of dollars every year, on top of her CPP and her OAS. That combined income will push her above certain thresholds, and she'll start losing some of her benefits. But if Dorothy, starting now, withdraws a modest amount from her RRSP each year, say $15,000 to $20,000, and moves it into her TFSA, she chips away at that balance gradually. She pays tax at a low rate today. She shrinks her future mandatory withdrawals. She protects her OAS. And she puts more money into an account that her children will receive tax-free someday. That's not a complicated strategy. It doesn't require a financial genius. It just requires knowing that the golden window exists and making a plan while it's still open. Before we wrap up, let me quickly walk through a few practical things that are worth knowing for this year specifically. First, your tax filing deadline. April 30th is the date that triggers most of your benefit calculations. The government uses your reported income from that return to determine what you receive for things like the guaranteed income supplement. Make sure your return is in on time and that any pension splitting between you and a spouse is properly completed. Second, if you have a younger spouse and you're converting your RRSP to a RRIF, you have the option to base your minimum withdrawals on their age rather than yours, because the younger the age used, the lower the required withdrawal. If your spouse is several years younger than you, this simple election could save you money every single year. Third, for those who qualify for the Canadian Dental Care Plan, keep in mind that household income needs to stay below a certain threshold. Large, unplanned RRIF withdrawals that bump your income unexpectedly could affect your coverage. This is another reason to plan your withdrawals in advance rather than reacting in the moment. And finally, for lower-income seniors who are receiving or may become eligible for the Guaranteed Income Supplement, if you still have money in an RRSP, there is a strategy some advisors recommend of drawing it down completely before age 65. This sounds aggressive, but by doing so, you arrive at the GIS eligibility stage with a very low reported income, which means a higher monthly GIS benefit. This is called a clean slate approach, and it can make a significant difference for seniors who truly need that support. All right, let's bring everything together. The central message of everything we've talked about today is this. In retirement, it's not just how much money you have, it's how you sequence your withdrawals that determines how much you keep. And in Canada right now, that sequence has consequences that touch everything from your monthly OAS payment to the tax bill your family will one day face. Your TFSA is your most flexible and protected asset. Use it strategically as a clawback shield for bigger expenses and as a legacy vehicle for your family. Your RRIF is powerful but taxable. Don't let it grow unchecked until age 71 if you have the opportunity to draw it down gradually during your golden window years. And your timeline between now and 71, if that applies to you, may be one of the most important financial windows of your life. The decisions made in that period, done thoughtfully and with good guidance, can protect your income, preserve your benefits, and leave more for the people you love. Now, none of this is meant to alarm you. These are manageable decisions. They just require awareness. And that's exactly what you've gained today. If you found this helpful, please consider sharing it with a family member or a friend who might be in a similar situation. And if you want to stay informed about the topics that matter most to Canadian retirees, we'd love to have you stick around. There's much more to come. Take care of yourselves, and remember, you've worked hard for this. Make sure your money works just as hard for you.